Hello, everybody. This is Andy Lebow of Commodity Research Group. Today, I am joined with Marty Stetzer, the president of EKT Interactive, and also my partner, Ed Meir, who was recently named the #1 base metals analyst in the world. Very impressive, by Metals Bulletin. So we're going to do our weekly commentary. We're going to talk about oil and metals and whatever else. Today is March 7th. Good morning, Marty.
Good morning, Andy and Ed. Happy to be with you again this week.
So we've got a lot to talk about. You know, there's actually a lot going on in the oil market, but the market's not really moving, but there's plenty. Luckily, there's a lot to talk about. I mean, the market seems to be just kind of stuck here in a narrow range. But you know, there's a lot going on that could easily change that range in one way or the other. I think I'm going to start just briefly going through the EIAs, which showed a crude stock build of 7 million barrels. You know, some people were really hand-wringing over that build, but the reality is it drew 9 million last week, and there was fog in the Houston Ship Channel, which prevented a lot of the imports getting in. Fog lifted, imports increased, and lo and behold, we had a build in stocks. I don't think it was. I don't think it was all that much of a surprise. In fact, we at Commodity Research Group were looking for a build of over 5 million barrels, and we were we were the highest. So I think we nailed that pretty good. On gasoline, a draw of 4.2, distillate a draw of 2.4, and total inventories were basically unchanged. Two things I want to talk about on the EIAs. One, kind of following up from our last report, gasoline's looking a lot better. It has drawn consistently this over the last few weeks. And, in January, it looked as though gasoline could really get into a bad surplus situation. And that has not happened in the least. In fact, gasoline has cleaned up. It's cleaned up nicely. Demand is good. And as a result, day supply are at 28. Versus a 4-year average of 27 and a half. So gasoline's in very good shape heading into the driving season. The cracks have rallied, so that is certainly one to watch. Diesel continues to be tight at 33 and a half days versus a 4-year average of 37.3 days. And diesel is definitely, that's something we're going to be watching very, very carefully as the IMO, as the IMO 2020 approaches. So Marty will be talking about that a lot as later in the year. And finally, on crude stocks at 453, day supply are 28 and a half versus 30. So crude stocks are in pretty good shape. Total stocks are 60 days. That's where they should be this time of year. So looking at the inventory data, it looks fine. It's not. I don't think it's in big oversupply. I certainly don't think it's tight by any means. So the inventories look fine. Now, looking ahead, there was a lot of talk over the last couple. Well, there's always a lot of talk, Marty, about U.S. production, and
exactly.
we hit another record of 12.1 million barrels a day. And it looks as though it's not only on land, but it looks like offshore that there's a good story for U.S. production.
Exactly, Andy. There was a really good article in the Houston Chronicle that talked about how the Gulf of Mexico production has really snapped back. The offshore rig count is up something like 30% over last year. And like the shale play in the Permian, they hit a new record in the Gulf of Mexico of a little over 2 million barrels a day. And there's a forecast that could increase 15% next year on the basis of projects that are already in the development production stage without any new discoveries. The other interesting thing for our listeners is the Gulf of Mexico production is generally a heavier crude, which is really needed by some of the U.S. refineries. So it might offset some of that gap that we have with what's going on with Canada and Venezuela.
Yeah, absolutely. And I think that the narrative has really been with the shale production, but I think it's really interesting that, we've got to start watching Gulf Coast production. And as you said, it's pretty important that that heavy crude starts coming out. There was a very interesting story in the journal this week about production in the shale production in the Permian regarding the wells being drilled wells being drilled too tight to each other, and as a result, the efficiencies aren't as great as what had been forecast, as they're interfering with the so-called parent well. The parent-child problem is I think is a good analogy there. And Marty, you have some interesting talking about analogies. You had a great analogy earlier on shale that I it would be great if you could share with our listeners.
Let me try it on our listeners. And by the way, this parent-child relationship is not new. I mean, it's new to the public probably, but I saw one of my first presentations on that problem in 2010 at the Society of Petroleum Engineers meeting when they were talking about multi-well interference in the shale play in the natural gas side, in the Marcellus shale. So I think it's recognized, but now it's a matter of trying to figure out how to optimize your well spacing as well as the number of wells. But people tend to think of the shale as a solid, continuous reservoir, which it is, but it's not all the same. And it's really difficult drilling. A friend of mine who is a geologist said, think of shale having the consistency of the concrete on I-70 and the permeability and the porosity of something that looks exactly like that. This is not a coal bed or a slate bed that has a lot of gaps and holes in it. It's really difficult rock. So analyzing what's going on down there is extremely difficult. And the long laterals that they're talking about now, 5,000, 6,000, 7,000 feet, the geology changes along the lateral, even if you're in the same geological strata that you'd like to be in. So what they've been able to do to get the production to its levels already has been technologically really amazing. And I'm sure they'll figure this other well spacing problem out.
Right. I think that they've proven with the use of technology that they will be able to figure out, they've overcome, as you mentioned, they've overcome so much just to get production up to where it is. You'd have to believe they're going to figure it out. The other thing I thought that was very interesting about U.S. production this week is, we've heard from the majors, and in particular Chevron, saying that they're expecting their production to go up in the Permian from 450 a day to 900 a day, and Exxon too, looking at gains in production, and you have to believe as the majors move in, the things will become even increasingly more efficient in the Permian.
And they have the long-term view and the capital resources available, unlike a lot of the independents that are so dependent on outside financing for what they're trying to do.
Exactly. Yeah, exactly. It's and that they bring a lot of capital to the game, and the game is going to change. The game is going to shift, I think, in favor of the majors. Let's just shift. Talking about shift, let's just shift a little bit to what we can look forward to over the next. Today's March 7th, so over the next couple of months, what I think the market is going to be watching. Obviously, it's going to be watching the what's going on with the waivers with Iran. India's already said that they're looking for 300,000 barrels a day. Iran is exporting like 1.3, and other Asian refiners are looking for waiver exemptions. So we'll see what happens there. Obviously, we're watching Venezuela very closely. Today it was reported that Venezuela is going to lose access to some of their tankers, which are tied up in Europe because the companies have not been paid. Companies operating those tankers, and their wells and their storage is filling up. So one would expect Venezuelan production will fall. We also will be watching the OPEC meeting next month. So there's and what's happening in Nigeria and also in Libya, where their major field has restarted. There's a lot going on, a lot to watch. A lot of traps on either side, so the market may not be moving, Marty, but we'll be watching a lot of things that can influence the market. So it should be a pretty interesting couple of months here.
So with so many wild cards out there, Andy, it looks like they're standing pat. Is that generally what's going on right now?
Yeah, I think so. I think people are, and you can see it from the commitment of traders. A lot of traders are just loath to place big bets right now, and you can't blame them, right? You just can't blame them. So with that, Marty, I'm gonna put on Ed Meir, who's going to talk a little bit about metals and the dollar. Because the euro's making a big move today. So Ed, take it away to talk about metals.
Hello, Ed. Nice to have you join us again.
Thank you very much. I will be brief, just to update your listeners on a couple of macro things that are going on. Today, the ECB came out and really slashed its growth forecast for Europe. I think it's now down to 1.1% from 1.7%, so it was a 0.6% drop. They've also increased some of this easy loans to the banks. They've extended some loans out to 2 years, kind of easy money for some of the banks to make use of. And they've extended their QE till the end of the year as opposed to the summer. So they've basically are admitting that things in Europe are not looking good at all, especially in Germany, where growth has really hit the wall. So net of all this is that the dollar is surging today, and it's kind of pressuring all the commodity markets except for oil. As you guys discussed, that seems to be holding up well. But if you look at base metals, precious metals, gold, silver, platinum, copper, nickel, they've all kind of had a rough week this week. Not a huge sell-off, but they're coming off their highs. I think another thing that's happening across the markets is the fact, the classic buy the rumor, sell the news with regard to the trade agreement. We've been rallying for weeks now on the back of an imminent agreement. We seem to have gotten the rudimentary outlines of a deal in place, and there isn't much more upside, especially in equities. They seem to be struggling today, and they've had this is the fourth down day in a row, although again, the declines are fairly limited. But the trade deal, I think, will come together. That's not a very out of the way position. Most people are thinking we will have some sort of a deal, but I think it'll be so watered down and so full of loopholes that it really won't be that robust. And I think the markets are sensing that as well. In fact, the Financial Times had a really nice checklist of items that the two sides are negotiating on, and I'll just go over them very quickly. The trade deficit component, buying more U.S. goods, the Chinese will give on that. They'll buy more soybeans, more natural gas. So that's an easy one, low-hanging fruit, so to speak. The next one is intellectual property rights. The FT is saying that they think the Chinese will play ball on that because they're already introducing some courts to adjudicate these matters. They're trying to protect trademarks and patents. So I think there'll be some agreement there. Subsidies is a third area. This is a real sticking point because the Chinese will probably not budge on removing subsidies. Subsidies are part and parcel of their economic fabric. A lot of their industries are subsidy dependent, so that's going to be a bone of contention. Cyber intrusions, cyber attacks. China is denying it's engaged in any hacking, so acknowledging something that you're denying doing is also going to be quite difficult. That's also sticky. The requirement to transfer technology, kind of open up your books when you come to China, that's also something the US is very concerned about. I think the Chinese will allow companies to come in without divulging their technologies, but I think they'll do it only in industries where China already has a big advantage, like the banks. No US bank is going to be able to compete with the Bank of China, which I understand has something like 100 million customers. So they're just too far ahead in some fields, and if they allow competition, it's going to be in sectors that they're already way ahead. And of course, last but not least, are these snapback provisions on the tariffs. I think that's also a big sticking point. China doesn't want to enter a deal and then find out a month later or 2 months later that it's not to the liking of the Americans, and tariffs are going to be snapped back. So I think that's a big Achilles heel in the agreement. I think for businesses, they want to see clarity. They want to see a tariff-free environment for 3 years or 5 years. They don't want to operate under a cloud of tariffs kind of being snapped back willy-nilly. So I have a lot of issues with the agreement, but the markets expect something to be done. It likely will get done, but it's not going to be foolproof. And lastly, we have the European car tariffs. This is really not on anyone's radar, but I think if we impose tariffs on Europe, I think the markets will really have a sharp fall. And that's about it. I'm available for questions if you have any, Marty. Otherwise, happy to wrap up.
Ed, thanks very much. That rundown from FT was really valuable because a lot of us, as you know, get bits and pieces, but this seemed like a very good checklist.
Yes, I thought so too. And in fact, we reproduced it in our monthly report, which is on your website. I think it's on page 3, so your readers can check it out.
Thank you. Thank you very much. Good talking to you.
Okay, thanks, Ed, and thanks, Marty. As always, you can find us on our website, which is commodityresearchgroup.com. My email is alebow@commodityresearchgroup.com. We have a brand new website, which is terrific, and we're getting a lot of great feedback on it. So please visit that, and we thank EKT for that. Marty?
Andy, really enjoyed being on the podcast with you. As I listened to Ed, maybe in one of our future sessions, we can talk about the oil and gas demand forecast now with this new, really low ECB economic forecast. I think our listeners would be very interested in how that's going to translate to barrels. But I appreciate being part of the podcast. I'm Marty Stetzer, president of EKT Interactive in Houston. If you're new to the industry and interested in learning more about the vagaries of the shale play or what happens in offshore production, take a look at our website, www.ektinteractive.com. We have 3 examples of our digital training that you can watch and listen on your phone. Thanks for the opportunity to participate, Andy.
Okay, thank you, Marty.